Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 8th of January. I'm Daniel Lam, your host for the podcast. 2026 is already shaping up to be an eventful year. We already saw what happened in Venezuela. Now Trump is making drums about Greenland. The Russia-Ukraine crisis remains in the air. AI is going strong, but there are always doubters about whether it is a bubble or not. And of course, risky assets can get volatile going into the US midterm elections. Now, our CIO team has done very well with its diversified approach over the last few years. But this stance is almost imperative for 2026. Yes, we do believe that earnings are supporting the AI-led rally compared to the tech bubble in the late 1990s. But valuations right now is elevated. It is important for investors, therefore, to consider adding some alternative assets to their holdings. In a portfolio context, investors typically use bonds to diversify their equity holdings, so-called the 60-40 portfolio. The key assumption lies in negative correlation between equities and bonds, government bonds in particular. So this means when equities fall, bonds would rally, reducing the volatility on the portfolio. However, this equity-bond correlation is not stable and it can change over time. So the benefits of adding bonds to a portfolio have been limited since the pandemic. In fact, it is positive and elevated today. This is because of the higher inflation regime that we're seeing. Now, for the 10 years following the global financial crisis, the challenge for the Fed was trying to lift inflation close to 2%, i.e. to avoid deflation. Since COVID, the challenge has changed to trying to cap inflation due to COVID supply disruptions, the Russian-Ukraine conflict, deglobalization, and the aggressive use of trade tariffs to rectify global imbalances. And here lies the case of adding alternative assets. Expected returns can increase with additional diversification, leading to significant improvement in the expected returns for the level of risk being taken. Up to a 30% allocation to alternative assets, including gold, can help enhance the risk-reward profile of investment portfolios. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.